In 1993, Congress buried a 6-page provision inside 1,700 pages of budget legislation that almost no one read. And the people who found it have been walking away with millions, completely tax-free ever since. The rest of the country is still paying. By the end of this, you'll understand exactly what was written into that law, who it was written for, and why almost nobody in Washington has ever wanted you to know your name is in it too. It was August 1993. President Clinton signed the Omnibus Budget Reconciliation Act into law. The headline was a tax hike on the wealthy. Rates went up. The middle class heard about that part. What they didn't hear about was Section 1202, 6 pages, buried inside a bill that ran longer than most novels. No front-page story, no op-ed, no financial columnist flagged it for ordinary Americans. Congress gave it a name so bland it sounded like a form you'd toss in a drawer, the Qualified Small Business Stock Exclusion. And then it sat there, quiet, dormant for years. Here is what Section 1202 actually does. If you hold stock in a qualifying small business for at least 5 years and you sell it, you pay 0 federal capital gains tax. 0 on gains up to $10 million, or 10 times your original investment, whichever is larger. That is not a typo. $10 million, untaxed. A single investment. If you are a founder, an early employee, or an investor who got in at the start, the federal government will look at your $10 million gain and say, keep it all. For context, ordinary Americans pay 15 to 20% capital gains tax on every dollar they make selling a stock. That's not a secret. That's the system. But a parallel system exists underneath it. One where a different set of rules applies. One where the number on your tax return for an investment that qualifies is simply 0. The official explanation is that Section 1202 was designed to stimulate investment in small businesses. Capital formation, job creation. The language in the statute sounds reasonable until you look at who actually used it. The provision sat essentially untouched for the first decade after it passed. The original exclusion was only 50%. The paperwork was complex. Most accountants had never heard of it. Then in 2010, something changed. Congress quietly amended Section 1202 and made the exclusion 100%. Complete. No federal tax on qualifying gains. That amendment was tucked inside a jobs bill, and that is when a very specific group of people began to pay very close attention. Silicon Valley noticed first. Venture capital attorneys began structuring every startup deal around Section 1202 compliance. Founders were issued stock specifically designed to qualify. Early employees were told, hold for 5 years, do not sell, the math works out to 0. Between 2010 and 2021, an estimated $30 billion in gains were excluded from federal taxation under this single provision. $30 billion. That is not a projection. That is IRS data. Now watch what happens next. In 2021, Congress tried to take it back. The House passed a provision inside the Build Back Better Act that would have capped the Section 1202 exclusion for households earning more than $400,000 a year. For high earners, the exclusion would drop from 100% back to 50%. And here is what makes it remarkable. The lobbying response was immediate. Intense. Technology industry groups, venture capital associations, startup advocates, all of them flooded Congress with the same argument. Rolling back Section 1202 would chill early-stage investment. It would punish innovation. The founders needed it. The provision was stripped from the final bill. Section 1202 survived untouched. The people who knew about it kept their 0. The people who didn't know about it, and that is most of America, kept paying their 15 to 20%. The same as they always had. The same as they were told they were required to. Here is what makes this different from most tax law. Section 1202 is not technically hidden. It is in the code. Any CPA can look it up. Any attorney can structure a deal around it. But there is a threshold that determines who knows it exists. You need to invest in a C corporation startup, not an LLC, not an S corp, a C corp specifically, with gross assets under $50 million at the time you invest. You need to be in early. You need to hold for 5 years, and you need to know to ask. Most Americans don't know to ask. The people who do know walk away with gains that are simply exempt. Their accountant files a form. The IRS acknowledges it, and no one involved is breaking any law. This is not fraud. This is the code. This is what was written in 1993, quietly expanded in 2010, aggressively defended in 2021, and still sitting there right now exactly as it was left. Section 1202 of the Internal Revenue Code. The question is not whether it is legal. It is. The question is why the people who wrote it fought to preserve it and built their wealth around it. Never once ran a campaign explaining it to the workers and small investors it was supposedly designed for. Who exactly was this provision built to protect?